Welcome back. This is Chart Overload. I'm Ryan Mumy, CEO of Sollinda Capital Management. With me, Justin Greenhill, our Chief Investment Officer. This is our Chart Overload for the beginning of August. Always a lot going on, and we'll try to go through some interesting charts that we find fascinating and what they might mean for you in the markets. You start with the big picture. First chart looks at weekly users of ChatGPT, and that continues to go up and to the right, Justin.
Good day. Yes. So one of the reasons we wanted to put these next couple charts here on the big picture section is because, as we'll get to throughout, you look at what's happening with price action. There's a lot happening, and we want to take a zoom out here and look at the big picture. So what is the big picture? The big picture is, in just a few years' time, people went from not really knowing what AI was to just on the ChatGPT platform. There's, roughly a billion people ultimately measured weekly, I think is the way it is. Yeah. So regardless of what we'll get to here in terms of market volatility and now what has become a question of profitability, this is to show there's something new and massive happening that, increasingly everybody's in on.
Adoption is happening.
Adoption is happening.
Yeah. Next chart looks at the time horizon for different language models to complete a task 50%, get it right 50% of the time. And as we see here, that's also improved dramatically over a similar time frame.
Even more dramatic, really. So the y-axis is basically different functions in terms of computer programming. Lower to the x-axis is less advanced, and higher, more advanced. And you see there's exponential takeoff in terms of, initially these models couldn't really do a lot, but now they can do, really more than a lot. They can basically do complicated things. Again, how that's used and how that's monetized by the companies involved, different thing. But big picture, we just want to reiterate that there's something underlying and happening within the economy that is far from frequent.
Yeah, it's able to do something that would take a human 12 hours. It's able to, the latest model, Claude Opus 4.6, is able to handle it, itself with a 50% success rate. But again, this just shows that AI capabilities are advancing rapidly. It's not far out in the future, right? This has happened, in real time over the last few years. Next chart looks at the CapEx, the spending that's been in the news headlines as some of these mega cap tech companies are seemingly being penalized for the amount of money they're spending as it relates to AI infrastructure.
Yeah. So, these companies in particular, Microsoft, Amazon, Google's done well, but a few of the others, Meta in particular, has done relatively poorly, are, after years of outpacing the stock market generally and growing massive in size, they're now making more money than ever and growing profits tremendously relative to other areas of the market. And as you can see here in this chart, to varying degrees, they're spending huge percentages of revenue on, everything that is AI, in hopes that that can obviously lead to return in the future. But one thing that we're talking about internally is the fact that there may be motivation for this expense that is more than just expectation of return, because this technology is obviously going to be increasingly critical to all things government, military, etc. So whether it be kind of wink, wink, nod, nod from the system, hey, you guys go ahead and spend, is probably more likely the case than the assumption that this is either like genius CapEx or .com level euphoric waste of CapEx. Because I think you were saying, Ryan, when we were talking about it, these companies, by the way, do have a history of getting CapEx spending right.
It's not original thought. It just stood out to me that Mag 7, X, Tesla, there hasn't been better allocators of capital over the last few decades than them, right? And you even pushed back that, well, Tesla got some things right too. So yeah, again, it's just interesting to watch not only the data, but the market's response to the data, which is why we do this chart overload, for us to talk about our viewpoint.
And just to square the circle, what we're basically saying is that the narrative has completely flipped to these companies can do no wrong, to now, on a relative basis for the past year or so, the market seems to, oftentimes when these companies announce more spending, the stock goes down on that announcement. And it seems the pendulum has now shifted maybe too far the other way.
Yeah, Google like showed an increase in cloud revenue by like 80 something percent. And then their stock was down, I don't know, almost 10% on earnings because they increased CapEx as the world turns. But we just find this exceptionally fascinating. And on that topic of there is a greater cause here than just the individual companies. This looks at the government's fiscal impact on GDP. And here recently it's went from additive to negative here in recent quarters.
Which this chart gets a little bit distorted in terms of how relatively massive the COVID and post-COVID time period was. But the most recent dynamic is really just all about what was the big beautiful bill, which had various different tax incentives and components to promote either government or personal spending. And although that, in our opinion, wasn't as big of an impetus into the economy as the AI capex aforementioned, it has been a factor for the past year or so, and it is now starting to roll off. And very importantly, it's now rolling off with interest rates moving higher, which also tightens liquidity. So, segue to the next chart.
Yeah, I mean, we'll see, right? Could this lead to some financial conditions tightening? And the next chart takes a look at treasury yields as it relates to the Fed funds rate. And yeah, as you see the blue chart, they've cut rates and held them here while US Treasury rates of various maturities have went up.
Right. So, in a very classic kind of market sense, if you just looked over time, not just the US, but various countries, this is ultimately the price action of the last two Fed meetings in particular. Is the market saying, we do expect you to hike, right? Because there is higher interest rates out into the future, which is also the market in some ways saying that in the absence of hikes, the possibility of inflation out into the future is increasing, right? The so-called term premium. So we've seen a big rise in that, but this sets up for a pretty classic scenario where, this could potentially be leading what becomes multiple rate hikes, which is the case from time to time. But in just as many, if not, I would say more times in history, this additional yield on the long end leads to the fact that those bonds can make a lot of money in return very quickly if in fact economic data deteriorates, et cetera, and the Fed starts to think about cutting rates. It's created a pretty interesting dynamic. And just generally speaking, across the strategies, we've been increasingly taking a little bit more duration throughout this after going a handful of years almost on the very short end of the yield curve. So opportunities abound there.
Next chart looks at it. It's one we showed actually last time. Was we were amazed at the total market cap of this one 3-time leveraged semiconductor ETF. And as we discussed, escalator up, waterfall down. Well, we've seen that.
Massively. And I think we got maybe another chart or so as this goes on. But what's happened in terms of the speculation in semiconductors, be it Korean speculation from there, or just this, what you're seeing here, a rush into a levered ETF product tracking semiconductors in the US has been massive. So this saw this one particular 3 times levered ETF for the semiconductors, ticker SOXL, go from roughly 30 billion or so in market cap up to 60 and back to 40 in roughly a month's time or less, which no doubt has had a big, big impact on certain areas of the stock market and the recent kind of isolated volatility that there's been.
It's been a lot. It's been a lot. Moving on to our next section, looking at domestic stocks. This first chart, carrying on with our previous one, looks at the 52-week drawdowns of semiconductors. And, as we see, that recent drawdown is in line with previous cycles.
So the dark blue line is the index, and then just the softer gray lines behind that are the individual components. So as you can see, not only are there some individual components that are down even more, but this is not the largest, but is in line with some of the largest what have been semiconductor stock drawdowns going back a number of years. And then obviously this has been an outperforming area of the market for the vast majority of that time. So I think in this area of the market, which is now 20% of the S&P 500, I think we've shown last time, it's just really important to keep an eye on what looks to be extreme conditions, both to the upside and the downside in the near term, because longer term, this is going to be an area of the market that is, you know, growing, if not the strongest, one of the strongest probably for the indefinite future.
What we opened with, right? Like this isn't just narrative. There are actual lots of people are using the language models, the AI models, and they're getting better. And semiconductors are critical to those functioning and operating. Next chart looks at, Samsung has been in the news, as Justin mentioned, with being a big component of the South Korean stock market, which has been all over the place. And this particular chart looks at their share price relative to their earnings per share. And as we see here, the earnings have went up as the share prices went up.
Yeah, so interesting to note on this chart, if you look at the orange, which is the earnings, you basically see that up until recently, it was really very cyclical, right? Earnings weren't necessarily growing, they were growing and then contracting, growing and contracting. And what's changed here recently in this space is that the previously commoditized and cyclical type of computer chips that a lot of these semiconductor companies are selling. The debate is whether or not they are secular in terms of earnings growth, or this is just one big cycle that is about to roll over. So if you go to the next chart, you'll see a analysis from Bernstein, the research third party, which basically shows that looking across, three of these individual companies, SK Hynix, Samsung, and another, what these recent earnings would look like if in fact they did roll over the same way previous earnings expansions have rolled over. And, ultimately, in addition to kind of a washout of leverage, that's what the market has been pricing in here over the last couple of weeks. It was a big cycle, but in some ways it's a traditional cycle. And then the other side of that bet would be where you say that, all right, the market's wrong in thinking that CapEx is overdone and this is, a traditional cycle. We're in fact in kind of like a, this time is different secular growth.
Because they're
And
projecting that earnings will continue to accelerate for another year, right?
and then roll over very
Correct.
hard.
So,
Right.
Even with what the market's doing, it's showing doubt awfully early, I guess would be my point.
Yeah, that's the best way of saying it with as few words as possible. Semiconductors are showing lots of doubt early to earnings inflection when considering how many people are using AI.
Yeah.
Square in that circle.
Yeah. Nice and quick.
Yeah.
Next chart, again, continuing with semis, because they have been in the news. They've been a big driver of overall equity markets. And this looks at volatility within the semiconductor, most popular ETF, and they've reached levels not seen since COVID.
Yeah, so this is implied volatility, where ultimately this is just showing how much market participants are willing to pay to hedge or buy insurance onto the downside, which, as you can see, outside of the early 2000s, there's really not been more expensive downside protection. So between a lot of, leveraged selling of semiconductors, fear over earnings, and then you look at this chart, the fact that the market is hedged, regardless of what you think, now we think is not the time to necessarily have a strong opinion to the downside on that area
To our previous charts, a lot of it's priced in already.
in the near term, right? Not to say that there couldn't be a digestion period and then a wave of additional negative fundamentals hit the space. It's possible, but in the immediate, there's a lot of negative priced in. Yes.
Next chart looks at the large cap ETF that tracks the energy sector relative to the 20 plus year US Treasury. And while the energy ETF appears to have broken out here recently to the upside, the Treasury ETF is close to breaking its support levels.
Which this is just kind of a fun little reminder chart in that, energy stocks, even though they can be volatile, and this is kind of how we've used them in some of our strategies, is they actually are a pretty good diversifier, right? When bonds aren't necessarily working and, in some instances, other areas of the stock market are not working, energy kind of has its own profile. And this just really kind of illustrates that. Bond yields have gone up, oil prices have gone up, energy stocks have gone up, right? That's kind of what is currently in the price and is trending at the moment.
All right, moving on to the next section, interest rates and the Fed. Again, we're looking at a similar chart to what we looked at earlier in the big picture, looking at US Treasury yields relative to the Fed funds rate.
Yep. And as you can see, The Fed funds rate back in the 2022 cycle, as we had discussed a bit earlier, was slow to move. Rates long end started moving up, and eventually those rates picked up, and the Fed raised rates above where the high ended up being in 10 and 30-year treasuries. But with a few rate cuts in and kind of the return of inflation and some monetary policy uncertainty, you've got these long end rates now looking to, price in what will be eventual rate hikes, or in other instances, this is the market getting ahead of itself in terms of higher rates, just as the equity market can get ahead of itself in terms of stock sell-offs in the near term. So one of the themes we're going to connect here, and if you go to the next chart, is just as everyone has scrambled to sell technology stocks, in particular semiconductor stocks, and pay a lot to hedge, people have been really quick to sell longer duration bonds. And as you see this chart here, the cost to hedge against or buy insurance for a further decline in bonds, a further rise in long duration yields, is also historically high.
Yeah, which again, it could be one of two things. It could be a bearish signal for fixed income that yields are going to rise even higher, or it could mean that positioning's gotten stretched and everybody's banking on yields going up, and oftentimes the markets don't do what everybody's positioned for. Next chart looks at high yield bond spreads, the difference between what a US Treasury is paying and something with lower credit, in the corporate world, and those spreads have widened a bit of late.
Yeah, widened, and I think we've talked about pretty ad nauseum about there's a school of thought out there that says that because so much, retirement saving in America is being forced into, traditional stock and bond portfolios, that a lot of that ends up finding itself into the credit market and sort of maybe keeps a lid on this. But nonetheless, you're seeing it widen out, but very notably to this point, far less so than the last widening, which in the scope of history, both are actually still very tight in spreads.
Yeah, it's similar to what we did with the US Treasury rates and the Fed funds rate. If we widened out on this chart, these they wouldn't even look like blips on a longer term credit spread chart. But they have widened, but they haven't widened that much. But going on to the next chart, part of the reason they have is one aspect of high yield credit is levered loans, and these types of bonds credit have not necessarily bounced back following the drawdown earlier this year.
Which I guess if one were to form a takeaway, you could just say that higher rates and relative illiquidity has, caused some sellers in that space. And this capital is likely just getting, rotated or reworked elsewhere. And that I think a pretty firm school of thought is just to think of trillions that is dedicated to fixed income globally, that's going to always prioritize the biggest markets first. And then there is some number of, billions or hundreds of billions of new money that's created in terms of either earnings or government spending every year. And that goes into some sort of retirement mechanism, which finds its way into, you know, these credit markets. So net, keeping an eye on it. But we were talking about this before recording. If we had to say what traditional signal might be less helpful now in terms of calling an economic recession or, a stock market decline, it's probably these credit metrics, less so than in prior cycles, maybe.
Yeah, that's that weight of evidence approach. It again, when you zoom out, it's a nothing burger, but to our conversation on it was it could be something if it continues and accelerates in that direction. Moving on to commodities. This first chart looks at crude oil, and obviously it's rallied here on renewed tensions in the Middle East and our war with Iran, but it's still not necessarily back to anywhere near where it was when the war first broke out.
The first chart just shows a weekly change in the price of crude oil, which you can see it became a lot more volatile in both directions, but has since settled down, relatively speaking. And then the second chart there on oil just simply shows that the big initial spike, although we're kind of having another spike, it seems to have been much less eventful, which I think, as we discussed a lot in the last video, really just goes to show that whether or not one can explain it, you can't deny the fact that, a global market that is set by tons of different buyers and sellers around the world don't think that oil prices should be in the future priced any higher than they are, regardless of what's going on with the strait. And then a lot of that comes down to headline risk. Just this weekend, new headlines are out that what? A deal is close. They want to talk.
And I love that they strike these deals before the markets open. I mean, that's gentleman warfare. So between the two charts, yes, there were some big moves. It's not anywhere close to where it was when things first started to break out in with Iran. Next chart looks at gold. Gold's been in a bit of a drawdown for several months, and this shows that July ended positive for the precious metal.
Yep. So we've had some stability here, which you can see on the first chart. There were two really big down months for gold, which really followed several really, really big months. And what seems very far removed now, because the recent kind of huge move up and then down in semiconductors has kind of taken everybody's attention. We forgot the gold, silver, copper run of, late last year into the early part of this year, which was equally big in magnitude, frankly, and then basically completely deflated. And now I think all metals, gold in particular, which you can see in the second longer term chart, are at a point where the upward narrative that made it go up, whatever was causing that demand, whether it be foreign central banks or et cetera, that's going to need to step in again for it to go higher. Otherwise, this kind of just looks like a deflated bubble.
Yeah. I mean, as we talked about at length when that was going on for much of last year, commodity cycles aren't like equity and traditional economic cycles, and they truly are boom bust. So literally gold could trade sideways for the next decade. I'm not saying it would.
50 years.
Yeah, I mean, it could. It has before.
Yeah.
Moving on to our last section, looking at the tour. This first chart looks at the US dollar to the Japanese yen, and we did not miss an opportunity in this chart overload for some Justin Greenhill artwork. If you see there's a big red bar because it looks like the Japanese central bank and the US Treasury and got involved this past week in strengthening the yen, weakening the dollar versus the yen.
Yeah, so this chart is dollar Japanese yen. So as the chart goes up, the dollar becomes more valuable versus the yen. And basically, what's been happening really since, I guess it goes back to 2011 when they elected Shinzo Abe as president. They've basically been doing everything they could to try to generate inflation in the country. And, ultimately, what went from being very low nominal interest rates, which encouraged people to sell yen and buy other currencies for the so-called carry trade. What's happened more recently is yields in Japan have gone up a ton on a relative basis to where it's a starting point, more than they have in the US, but inflation's also gone up quite a bit there, and it's been made worse by higher energy prices because they import so much energy. So net, the Japanese yen has been kind of continually weakening. And second chart here, you can see where Treasury Secretary Scott Bessent went down to Camp David to meet with Rubio and the president, JD as he's called. He's on the podcast circuit right now, dude. JD's finding a brilliant sweet spot in terms of like standing with Trump, but yet like the optionality to turn against the war in the future and like do like I told you so, like I tried to stop it. I mean, brilliant politician. But nonetheless, Bessent showed up with a notepad with scribbled handwriting that said to do buy 15 to 20 billion in yen.
Yeah, I thought it was AI, but people are saying it's legitimate that he literally had, like, I think of my to-do list oftentimes by management, my wonderful bride, but my to-do list, like, that's a pretty big one, buy a lot of Japanese yen. So, and again, the price action confirms that somebody with massive flow is moving that currency pair.
The jokes aside, I think a big takeaway from this, whether you look at the past administration, this administration, and just kind of the trend of what's happening with the deficit, et cetera, in the US, and the need to spend more money on military and AI and all the things that we're talking about, is there's not really a political function or a political group, I guess you could say ideology in the US that has any power right now that wants a stronger dollar.
Yeah.
For pick your reason. Like this group that may hate this group has something in common somewhere that a weaker dollar is better.
Yeah.
That's really kind of where things have gone. And although that doesn't necessarily tell you what the dollar is going to do against everything, I think something that we're really thinking more and more about is some of these places in the world that have like real resources that in the past have been punished for having, government spending be out of control are now maybe going to be punished less when the ongoing narrative is that the US needs a weaker currency to help with its own idiosyncratic, global position. And yeah, Mr. Besant seems to be wanting to play a role in that.
Yeah. Right.
He was a hedge fund manager,
Yeah, that's
which,
that.
which by the way, him and now Fed Chairman Warsh both worked for Stan Druckenmiller, who obviously, famously was Soros's portfolio manager. So in terms of like how to use policy to influence markets and then markets will help influence policy, that
No,
so-called research, they're thinking through that.
yeah. I mean, they're actual practitioners. They're not academics. I mean, they did the deal. Next chart looks at the emerging market benchmark, the MSCI Emerging Market Index, and it just shows that it's participated in significant volatility middle of June through towards the end of July and has bounced back. But despite that, even at its big drawdown towards the end of July, it's still up, I don't know, over 10% on the year. They've had a very good year, albeit volatile recently.
Yeah, and we show this just to kind of reiterate that that particular index, MSCI Emerging Markets, which we would say is most people or most portfolio, at least on the retail level in some form or fashion, that's their dominant exposure to EM, if at all. And a lot of that is now extremely concentrated in Korea in particular, but also in Taiwan, which kind of makes it more positively correlated to the semiconductor trade and what we talked about before than it has been historically. So if we go to the next chart, we want to kind of put a chart of Brazil, which, within emerging markets, I think what we want to show here is it really kind of moves in very different form and fashion to what's happening in Korea. So within emerging markets, we're not saying that buy and hold in either one at these levels is superior than the other. If anything, we would say that even if Korea is more speculative and volatile, from an earnings standpoint, it might be the superior buy and hold. That I guess the verdict's always out. But what we are saying is they both complement one another in terms of their diversifying effect.
Yeah, and not everything moves in the same direction, even though they're in the same category. Similar to what we've seen in the US large cap indices, you've got tech, semiconductors going down a lot, and you've got other aspects of the S&P 500 that have went up. So again, it's dig a little deeper. But that was this chart overload. We appreciate you spending some time with us. We know you could spend that time a lot of different places. We hope you took something away positively. If you have any questions, want to dig any deeper on any one topic, please reach out to us at info@sollinda.com, info@solinda.com. We'll be back in a couple of weeks with our next chart overload. We'll see you then.